Hi, good afternoon. Thank you for joining. I know everybody's time is valuable and nobody is really clamoring for another Zoom meeting, so I appreciate the time. Hopefully this will be valuable. As a reminder, this is our monthly educational webcast 2310, where we spend 23 minutes going through some financial education meant to be very educational, and then have 10 minutes for Q&A. So again, thanks for joining. This is live on last day of the month here in August, and this will be available for replay as well. Everybody that's on this will get a link to watch the replay should you want to watch it again. Or if you've signed up and missed it, that replay is available as well. Feel free to share this too if there's somebody out there that you think would benefit from it. So we're going to get into our topic today. This is our fourth time doing these, and topic this time is where do we go from here? We're going to get into a mid-year economic and market outlook. A couple things to note before we get going here. One, this is live and we're taking Q&A, and so you have Q&A functionality in your Zoom controls. So if you have a question, submit it at any time, and we will try to get to those at the end in that last 10 minutes. The other thing I would note here is that if there's a topic that you'd like to see us cover in an upcoming webcast, let me know, reach out, and we'd love to hear from you, and we'd love to potentially address that. So only other thing I will say is in these slides today, there's going to be quite a bit of data, charts, information. And so I'm going to try to go through them fairly quickly to stick to that 23 minutes. But should you want a copy of the presentation, we're not going to put it out on the website, but if you want a copy of it, if you want to dig deeper into any of the slides and the data, let me know, reach out, send me an email, and I can get you a copy of the slides. So just send me an email. Most of you probably have it, but if you don't, it's just isaac@cordantwealth.com. So reach out and get a copy of the slides as well. So let's get into it. So again, we're going to spend 23 minutes on our topic of the month, and then devote some time to Q&A as well. So just a quick recap on where we are year to date. This is the S&P 500 index. Again, 500 largest companies here in the US, and as you all probably know, about a 34% decline, which is right in line with an average decline for a bear market. Since then, we're now up 57%. So we have reclaimed the high for the year, puts it at all-time highs, actually. We did an investment update earlier this year. I think you can find that one on YouTube, where we looked at what happens once we get back to all-time highs. And kind of short story is, you shouldn't be concerned. Markets that are all-time high in and of itself isn't necessarily a bad thing. So we are back up 57%. It puts us back to all-time highs. One thing that I always like to just recap is what we've seen this year is average in some ways, down 34%. That's a very average bear market. With a strong recovery, that's also fairly normal. The average one-year recovery is 47%. We've done better than that so far this year. So, but even still, kind of within the range of what we typically see on a bear market. What has been unusual about 2020, I mean, a lot of things, but from a market perspective, the speed of the drop and the speed of the recovery has been a bit unusual. It's been a health crisis. So one thing we want to check in on is the numbers there on the health side. So it's an economic situation caused by a health crisis. So really some good news. Things are trending in the right direction here. So tests have remained stable, continuing with the testing, but cases, hospitalizations, and deaths have started to decline and are certainly trending in the right direction. So good news there. Also some good news continuing to come out on the economic front. So this is the Citigroup Economic Surprise Index. So we've looked at this in the past, but basically what it's telling us is information, economic information, coming in better or worse than expectations. And again, it continues to come in better than consensus or better than expectations by a fair amount. So this is one of the things that's really been driving the markets and driving the recovery, is the information, the economic data continues to come in better than expectation. So that's a bit of good news as well. So that's the quick check-in. What we want to spend most of our time on today is this topic of the month: where do we go from here? I'm going to break it into 4 components. So first, we want to just assess the damage to the economy based on what we've gone through here in 2020 in the health crisis. what's the policy response and what's the impact of that, the market impact from a financial system perspective, and then importantly, where do we go from here? So economic outlook and a market outlook. So we're going to get into each of those. I'm going to leverage heavily some research by Vanguard. They did basically their mid-year economic update, and we're going to leverage that. This was done at the end of July, so it's a month stale, but given the longevity of some of these topics, relevant to go through. And then I'm going to incorporate in some other information and sources as well to that. So let's jump in. First thing on the assessing the damage piece is just the level of uncertainty that's out there. This has been an unusual year in many ways, and financial uncertainty is no exception. What you're seeing is the World Uncertainty Index, which is essentially a project that a group was put together tracking economic data across a bunch of different countries and really looking at the text for how much uncertainty or things like that is mentioned. And what you can see, I mean, this goes back to the 50s, is really record highs, higher than the 2008 financial crisis, higher than like the Brexit or the debt crisis in Europe in around 2011, 13, 15, higher than the tech bubble crash. And so really high levels of uncertainty. The point that I would want you to take away from this is really twofold. So one, if you take nothing else away from this presentation, I think remembering this point that there is a lot of uncertainty out there, nobody's going to be able to accurately tell you, what's going to happen next or how this thing is going to play out. If that's one point I think that we should all remember. The second point would be something that we'll touch on at the end, which is basically Vanguard's conclusion. Therefore, as a result, some of the underlying foundational principles that you should think about when investing still do apply. So these are things like think for the long term, be diversified, don't try to time the markets. So I think those bookends to the presentation, if you take nothing else away, would be appropriate. But point here is 2020 has felt like a crazy year, and based on economic uncertainty and what everybody across the globe is feeling, that sense is validated. That plays out in the GDP forecast, or the aggregate of all this economic data. So what Vanguard is forecasting is across the globe, GDP is down by 3 to 4%, which stack that up in the last 150 years against other things we've lived through is up there with one of the worst periods. The only things that surpass that in terms of a global GDP drop would be World War I, Great Depression, and World War II. The global financial crisis, is over here on the right, and it's a pretty small drop. I mean, it was a serious recession, but small in terms of GDP impact in 1 year compared to the forecast for 2020. This shows up, plays out in unemployment. Obviously, that's one of the big data points and real world impacts of this. This is data, again, across the globe here, so US, China, Japan, and then some of the Eurozone, UK, and Australia. And what you can see here on the blue, and then you have the middle kind of greenish and then the darker blue, pre-COVID unemployment, you've got the kind of the official number and then the estimate if furloughed workers were to be included. And you can see the different treatment of furloughed workers across the globe. US, the official number is pretty close to the estimated number with furlough. You get into the Euro area in the UK, that's a much higher number with furloughed workers included there. But what you can see is one of the biggest impacts of the pandemic has been people unemployed basically across the globe. So one of the things obviously that we're tracking here in the US and looking at across the globe is how quickly are people getting back to work. And we'll talk a little bit more about that here in a little bit. The other thing in terms of assessing the damage that I'm sure most of you are aware of, but kind of shows up in the numbers here is different sectors, different areas of the economy are affected differently by this. So here you're looking at a scatter plot. The further out on the right you go, the more persistent the shock would be, I mean, how long it's going to last. And then on the y-axis, kind of the up and down, is how big is the impact on GDP. And so you can see those sectors in purple over there on the bottom right, retail, some of arts, recreation, food, even transportation, a bigger impact. Whereas in the upper left, technology, information technology, finance, professional services, anything with the ability to work from home has been impacted less. And so I obviously that plays out from a employment perspective, but also from an economy, from a company perspective, which ones are better positioned throughout this, at least according to Vanguard. So that's a bit on the impact, obviously a big impact, as we saw one of the bigger impacts to GDP, really going back to World War II. And so what has been the policy response? It's been quick and it's been pretty drastic, not just in the US, but across the rest of the world. Pretty quick, not so much coordinated, but all countries, governments have responded by doing some of the same things, not necessarily coordinated, but they're all taking the same measures. So these typically get broken into two buckets. So you have monetary measures. So here in the US, these are things that are done by the Federal Reserve to make money easier, interest rates lower, things like that. And then you have fiscal response. So these are things typically done by Congress here in the US. These are things like the extended unemployment benefits and the like, tax policies, tax benefits, tax cuts. What you can see here is pretty much across the board, all these major countries have done something in each of these categories. China is kind of the one outlier there, but from a fiscal perspective, across the board, they've lowered rates. They purchased debt known as quantitative easing. They've basically been a lender of last resort in the banking system to make sure that money can continue to change hands. Really, the point there is to prevent the health crisis and economic impacts from turning into a financial system crisis. On the fiscal side, this is the CARES package here in the US, where money goes out to individuals, unemployment programs are extended, tax incentives and breaks are put out there. So pretty major and swift policy response. You can see that here when you're measuring the magnitude. So I think the one point that I'd like to make on this one is just where the US stacks up across the globe. The $6 trillion, so roughly $3 trillion in the CARES package and other fiscal stimulus, and roughly $3 trillion of monetary stimulus is a very big number. But if you're looking at it as a percentage of GDP, because the US is one of the largest countries across the globe, it's not on a percentage basis the largest response across the globe. So you can see Germany, Italy, Japan, UK, France, and Australia on some different measures, or both measures, actually have had a larger policy response as a percentage of GDP. So yes, the US has done a lot, but other countries have done a lot as well. Germany and Italy being some of the biggest in terms of their response. How's all this then impacted markets? I'm sure most of you have been paying attention here, but the thing to note is, again, the speed of the drop and the speed of the recovery. So again, you're looking at COVID versus the global financial crisis, 2008, and the tech bubble in 2000. We, again, saw that 34% drop, but it's bounced back pretty quick. You can see some of these the global financial crisis was about 350 days before the bottom. The tech bubble was spread out over 2000, 2001, 2002, 700 and some days to the bottom. So obviously a big impact, but much faster than some prior crises. In terms of global diversification, Vanguard definitely is a big proponent of this. And the thing that I note here is, obviously it has impacted the whole globe. It's impacted markets across the globe, but the severity of the drop has been different in different countries. Most of them, other than China, which is an interesting exception, but most drops between 30 and 40%. The thing I would point out to, and Vanguard says here the value of global diversification from a U.S. perspective. Actually, being all U.S. in this period would not have necessarily been a bad thing. The markets had one of the least severe drops and has had a good recovery. At the point of this chart, June 30th, it was down about 3% year to date. So not a bad outcome. But think about it from the other side. So the benefits of diversification from an investor in the UK or Canada or something like that. If you had all your money in that home market, potentially still down 22% year to date. So I think you have to take yourself out of a US perspective when looking at this chart and viewing, yes, there is some benefit to being globally diversified. The US has been a good place to be, probably one of the best markets to be for the last 5 years. But it isn't always going to be and hasn't always been the case. So it doesn't take too far back to look back to the tech bubble, that crisis from 2000 to 2010, a 10-year period, really known as the lost decade for the S&P 500. The market for 10 years actually had a negative total return over a 10-year period. So just because the US has held up okay in this environment doesn't mean it's the best place to be always and forever. There have been other periods where the US market has not been the best place to be. So that's, I think, the main takeaway there is, yes, all markets have been affected, but they have been affected differently across the globe. Moving on to kind of the next point of, given all this, given the health crisis, the market impact, where do we go from here? Vanguard sees a couple different scenarios that they outline. So upside, baseline, and downside. They're going to put the most stock on the baseline forecast, which is essentially more or less a continuation of where we are today, a gradual kind of staggered return to normal. They do see a significant risk of basically downside to that baseline. So this would be things get worse from a health perspective than the estimate right now. So the virus gets worse, vaccines are delayed, things like that. And they give basically a 1 in 3 chance of that happening. On the upside surprise, you'll notice like all these are health related. So maybe we get treatments or vaccines faster. Maybe we're closer to herd immunity than previously thought or thought currently. And so they're giving extra weight to the downside versus the upside, just kind of looking at it through the lens of health perspective. Now, interestingly enough, there are some positive, some outlooks to that, some upside surprises that I'm going to get to here in a second. But in terms of expected GDP recovery based on that, this is kind of what Vanguard is putting out there as their estimate. And so what you can see for markets across the world, focusing in on the US, you see a bit of a V-shaped recovery, kind of getting back to where we started by the end of 2021 as their baseline. But the other thing to note here is that the greenish line at the top, which would be the prior trend line, if there was no recession, if we continued to grow at the rate we were previously, we don't get back there by the end of 2020. It might take another year to get back to that trend line. So that's kind of their baseline, what they're estimating. So China, in terms of their estimate, gets back there sooner. Eurozone, maybe the gap is a little bit smaller, but obviously some real impact across the globe. And while V-shaped, still have work to do to get back to the point where we started or the prior growth line. Now, I did mention some kind of upside potential. And these charts, next couple of charts, come from Tim Dewey, who's an economist at the state of Oregon. Actually have interviewed him recently for our Beyond the Crisis series. And so if you want to get into this a little bit more in depth, I would recommend listening to that interview, which hopefully will be posted this week. He sees a lot of data in the economic data that actually has some upside surprise potential. So based on what consensus is and out there and what the markets are expecting, there's actually some potential good news to that or upside to that. So while Vanguard sees a lot of risk to the downside based on health health effects getting worse. He sees from an economic perspective, some things are actually better than people appreciate right now. One of them is the residential real estate market, which has been on fire, as I think a lot of people probably know. Here we're looking at new single-family homes sold, which actually has not only had a V-shaped recovery, it's actually higher, the number of new homes sold, higher than the prior trend. And if you look at really any residential data point, home builder index, existing home sales, things like that, it's all looking really good. And this is important because housing is typically a leading indicator to the market, to the economy. And so there's a lot of additional money that's spent as a home purchase happens. So money to contractors, money to realtors, typically money spent furnishing the home, things like that. So there's a lot of other money that can be stimulative to the economy based on a strong housing market. Other thing that he points out is the amount of money that's in checking accounts out there. So based on some of this stimulus payments that were given to individuals through this year, there's about $1.5 trillion more in checking accounts across the US at this point than there was at the beginning of the year. And this is not a trivial increase. It's about a 60% increase. And so the point that Tim makes here is, one, if unemployment benefits don't get extended, well, this is some money that people can use to kind of ride out this if they're not getting back to work as quickly as they maybe thought they were. Or two, if unemployment benefits do get extended or people get back to work soon, this is money that's sitting out there. Most of the time, people are going to spend the money in their checking accounts. So this is money that, hot money essentially, that can be put into the economy at some point. So delayed car purchases, TV, electronics, things like that, vacations that have been on hold. This is money that is sitting there in a checking account ready to be potentially spent. So he views this as a positive data point that's maybe underrepresented, underappreciated by market participants at this point. Really quickly, the other thing that he mentions is the purchasing manager index. So these are people, service industries or manufacturing industries, people buying on behalf of companies. And so this has bounced back really quickly to the extent that companies are seeing demand. This should help to boost hiring, driving the unemployment rate down that we looked at before as well. So he sees some significant, again, potential upside. The data might be even better than people are appreciating. So it kind of balances out Vanguard's view. One other thing to check in here on the outlook perspective is just where our valuations from an equity market perspective. There's a lot going on in this slide. So again, if you want the slides, reach out. But basically what you can see on the left is the teal line is somewhat right in the middle of that gray span, which means from a US equity market perspective, right at fair valuations. On the chart on the right, where you have red, yellow, green, if something in the red would be overvalued, yellow is basically fairly valued, green would be cheap or undervalued. And so what you can see is US bonds, US stocks, right there in basically the 50th percentile fair valuation, and outside the US, the markets roughly the 25th percentile. So still in that fairly valued bucket, but getting pretty close to undervalued or cheap. So from a market perspective, yes, we have dropped and bounced back, but kind of still in that range of really fair valuation there. One other thing that just really quickly touch on, this is from JP Morgan, so not from Vanguard, but you can kind of see this is quantified value of rebalancing, I would say. So this is their outlook for returns going forward for different markets. The September 30th column would be, fourth quarter of 2019, what they're expecting for returns going forward. March 31st, which is essentially the bottom, return expectations going forward. And you can see a change of somewhere between about 1 to 2.5% across these different markets of higher return. So this is kind of that buy low, sell high, or rebalancing. Like, this is why you do it. It's not going to feel comfortable to be buying stocks on March 31st, but you get paid more for doing it during periods like that. Kind of the last question that we get through all this is, what about the debt? So we mentioned the $6 trillion in the US. We mentioned a lot of countries across the globe have done a lot of stimulus. How are we going to pay it all back? There's really four options here. There's austerity, budget cuts, spending less. which tends to reduce growth. There's growth, which the highly driven by demographics. And so a lot of the developed world doesn't have a lot of population growth right now, low rates, and then inflation. So Vanguard, their analysis and what I've read elsewhere as well, there's not a lot of appetite for austerity. Low rates and inflation are kind of how we're probably going to work our way out of this. Low rates are helpful given that the debt service is not high because rates are low. And so there's not a lot of concern there from them. Kind of the debt service to GDP is at very healthy levels. It's not an extreme level. And then on the inflation front, obviously a lot of central banks across the world have been, inflation's been low, and they've been trying to bring that up. Here in the US, the inflation target's about 2%. We were just getting back to about that 2% inflation. Recently, the Federal Reserve has kind of changed their policies a little bit to, in the past, 2% has kind of been the cap, the highest they want to see inflation. They've changed that a bit and kind of acknowledging the inflation has been below that target to target more average 2% inflation. So if it's 1% one year, maybe we want 3% the next year, so it averages out. And so what Vanguard sees and others see is this low rates comboed with some inflation is probably how we work our way out of the levels of debt we have. So the one point I would make is if you're concerned about the level of debt in the US, inflation is actually probably a good thing. That makes obviously dollar go farther or dollars cheaper, and then it's easier to pay back down that debt. So you shouldn't be both worried about the level of debt and inflation. If you're worried about one, it should be one or the other. Again, the interview that I mentioned with Tim Dewey, we chat a little bit about debt levels and inflation and what the Federal Reserve can do. So if you want to dive in deeper to this, I would again recommend that interview. But long story short, there's probably not a lot of appetite for an austerity, and low rates comboed with inflation is probably how most countries try to work themselves out of where we are today. Just a real quick summary, and then we'll get to the Q&A portion. I've not seen a lot of questions come through. So again, reminder, if you have any questions, go ahead and submit them, and we'll spend the last few minutes chatting through some questions. But summary of all this, we covered a lot of ground. So again, if you want the slides, go ahead and reach out. But this year, 2020, has been one of the sharpest and steepest contractions we've seen in history, primarily driven by a lot of the economy just getting shut down. Response was pretty bold from a policy perspective. And from here, a lot of the recovery is going to be based on confidence, people's confidence getting back to work, getting out into the economy, spending money, resuming their normal activity. So still very much a health situation, and people have to be comfortable getting back to the normal life. From there, really the two sides of the equation are the health side. Vanguard sees some skewed risks to the downside based on negative health outcomes. So a lot of where we go from here is going to be dependent on what the health situation looks like. There are some economic surprises. So again, real estate's been strong. Business data, some indicators are bouncing back well, and there's a lot of money sitting out in the economy, sitting in people's checking accounts. So, one of the big questions on the economic side, a lot of positive economic data, but one of the big questions, well, how quickly or how confident will companies be in bringing people back to work? We are still seeing some improvement in the unemployment numbers and continuing claims and things like that, but how quickly does that happen and get accelerated? From a financial market perspective, this is the conclusion that Vanguard put in this economic outlook paper, but I would definitely agree with these things. It's tempting when there's a lot of uncertainty to change up the playbook, but they refocus us back to the fundamentals. So focus long-term, global diversification, and avoid that temptation. And it's hard, especially when you see everything that's going on and people speculating in Tesla and all these other stuff. Avoid that temptation to time the market. So that's it for this month in terms of information. Hopefully this has been helpful and useful as always. Please let us know if you have any additional topic for the future. And now's the time. If there are any questions out there, Q&A, we'd love to take some of those. So go ahead and submit them. I'm not seeing anything now. I'll go ahead and give it a couple minutes or a minute or so. And if there are no questions, we'll go ahead and conclude and wish you all a good afternoon. So I'll go ahead and hold on for here a second if anybody has any questions. Well, it doesn't look like we're going to get any questions today, which is perfectly okay. Thank you again for joining. Appreciate you taking out the time, and hopefully this has been useful for you. If you want the replay, it's going to be available. Just look for an email. And again, if you want any of the slides, make sure to reach out and we can get those to you. My email, again, is just isaac@cordantwealth.com. If you want to copy the slides, send me an email and we'll get those to you. Thanks again for joining. Hope you have a good afternoon, and we will see you next time. Bye.